Things are not looking good for China. The debt supercycle from the 2008 financial crisis is finally catching up with them. China's unstoppable growth? Well, it looks like it's hit a roadblock. Despite being the second largest economy globally, their financial system is showing more cracks. Youth unemployment is through the roof, and they've even stopped reporting the numbers. And trust me, this is just the beginning of what could be a bumpy ride ahead. Is China's economy collapsing? Let's find out. We're diving deep into what's going on, why things are getting worse, and what this could mean for us in the good old US of A. First of all, China's been on a serious winning streak for the past 3 decades or so. Ever since 1979, when they struck up diplomatic relations with the United States, the floodgates opened. Money poured in, infrastructure boomed, and they became a hub for global investment. They even joined the World Trade Organization in 2001, hoping to strengthen ties with the US. But here's the thing, while it seemed like a win-win, things got a bit complicated. China's rapid growth gave them serious leverage on the world stage. They started flexing their economic muscles, allegedly playing dirty by offering illegal subsidies to their businesses, manipulating currency, and controlling supply chains. Sure, it boosted their economy, but it raised some eyebrows internationally. Now, fast forward to today, and we've got a whole new set of challenges to deal with. Despite all this economic turbulence, China is still aiming for around 5% GDP growth in 2024. But domestic demand is at rock bottom. And when you've got a whopping 1.4 billion people, you kinda need them to be out there spending money to keep the economic engine chugging along, not sitting on their wallets. Let's break down the nitty-gritty of that consumer price index data. We'll also take a peek at what's up with food prices and those factory gate prices. Oh, and there's some not-so-great news brewing in the manufacturing sector too. Then we'll get back to the stock market and what's up with the Chinese yuan because things aren't looking good for both. Let's take a look at the chaotic consumer prices in China over the past year. The latest data for January reveals a 0.8% drop in prices compared to last year. And get this, it's the 4th month straight that China's seen prices taking a dip. Now, let's zoom out a bit. Over the last 8 months, starting from June 2023, China only had 1 month where prices went up, and even then, it was just a tiny 0.1% rise in August. We're talking about serious deflation vibes setting into the Chinese economy, influencing how people shop and spend. And if we stretch the timeline even further, like over the last decade, you'll see that the current price slump is the worst China's faced in years. Like, seriously, it's the pits. And if you look broadly at the past 25 years, well, because it's the direct situation since way back in 2009. If you check out the charts tracking the ups and downs of food prices in China over the past year, it's been a rough ride. For the past 7 months straight, prices have been on a downward spiral. And get this, in January alone, they plummeted by a whopping 5.9% compared to last year. Over the last decade, this slump is the worst China's seen in food prices. And if we stretch it back even further, like over the past 25 years, it's the bleakest situation since the late 1990s. That's over 2 decades of struggling with prices. Usually, when we talk about food inflation, it's all about prices going up, right? But here's the twist, prices are dropping like crazy in China. Sounds like a win for shoppers, right? Well, not so fast. While it's good news for folks on a tight budget who can buy more groceries for less cash, it's a whole different story for Chinese businesses. If you're a food producer watching your product prices nosedive while your production costs stay the same, it's bad. You're either making less profit or even operating at a loss. And when you're trying to plan for the next few months, it's like navigating a maze blindfolded. You're forced to make tough calls like laying off staff or cutting wages just to stay afloat. Now, here's where it gets tricky. If this price plunge keeps up, we could see some of these businesses shutting down, and that spells trouble for the food supply. Imagine shortages of your favorite snacks or essentials on the shelves. So while cheaper groceries might seem like a win-win, it could set the stage for a roller coaster of price hikes down the road. Alright, now let's take a look at the world of producer prices in China. Think of these as the prices companies slap on their products as they roll out of the factory gates. Now, look at this chart tracking those prices over the past year. It's a bit of a downer. For a whole 12 months straight, prices have been taking a nosedive compared to the same time last year. And get this, we're now in the 16th month of this downward spiral. Now, why is this such a big deal for companies? Well, imagine you're running a business and your prices keep dropping. It's like trying to swim against the current. You're either slashing costs left and right or watching your profits shrink faster than you can say budget. Planning for the future? Forget about it. When prices keep falling, it's like trying to hit a moving target blindfolded. Sure, you could try cutting staff wages or trimming raw material costs, but that only gets you so far. Now, here's where it gets tricky. If you're buying stuff from other countries, like raw materials from overseas, things start to get even messier. See, while prices in China are dropping, prices abroad tend to go the other way. Up, up, up. And to add fuel to the fire, the value of the Chinese yuan has been taking a hit lately. So if you're swapping yuan for other currencies to buy stuff internationally, it's like your shopping cart just got a whole lot pricier. Now, imagine being in the shoes of these companies. It's like being stuck between a rock and a hard place. With prices dropping and currency woes on the rise, turning things around feels like trying to juggle flaming torches in a windstorm. Tough times ahead indeed. What about the producer price index and consumer price index? First up, let's talk about the producer price index. There are moments when producer prices take a nosedive. Back in 2019 and 2020, during the COVID-19 chaos, China had to slash prices to keep those goods moving. Understandable, right? But if you rewind a bit further, between 2012 and 2017, there's a long stretch of falling producer prices. What gives? Well, it seems China was on a quest for volume, pumping out goods left and right. So when global demand took a hit, prices had to follow suit. But here's the thing, constant price cuts meant slim profits for businesses. Imagine running a shop where you're constantly lowering prices, but your costs stay the same. Now, in a typical capitalist setup, businesses facing this kind of crunch might go belly up. But China's not your typical capitalist playground. So, who's gonna pick up the tab for all these struggling companies? Will the government come to the rescue or let them sink? It's a bit like a high-stakes game of financial chicken. Switching gears, let's talk about consumer prices. Notice how they don't always dance to the same tune as producer prices? That's because a big chunk of China's industry is geared towards selling stuff abroad. So while producer prices may be on a roller coaster, consumer prices can march to a different beat. Alright, let's dive into the Purchasing Managers Index (PMI) chart for China, tracking both manufacturing and non-manufacturing businesses. Now, in January 2024, the manufacturing PMI clocked in at 49.2. But what does that number mean? Well, imagine a scale ranging from 40 to 55 as a sort of economic mood ring. If the PMI is above 50, it's like the economy is doing good. Businesses are growing and thriving. But if it dips below 50, it's more like a rain cloud. Businesses are shrinking. And guess what? In January, the manufacturing PMI dipped below the crucial 50 mark for the fourth month in a row. And that's a big deal because manufacturing is like the heartbeat of China's economy. When it's not doing well, it's like the engine sputtering. Now, historically, when China hit a rough patch, it would give its economy a jumpstart. But lately, despite all the efforts to rev things up, the engine's still struggling. Even after the COVID-19 restrictions were lifted in 2022 and there was a brief surge in confidence, the PMI mostly stayed in the doldrums. So what does this mean for China? Well, it's a bit like trying to fix a leaky boat in the middle of a storm. Not an easy task. And for now, the choppy waters of economic uncertainty seem set to continue. Let's take a peek at the CSI 300 chart over the past year, which tracks the performance of China's top 300 companies. Over the past 12 months, we've seen some significant dips in the index, hinting at some turbulence in the market. January 2024 didn't bring much relief either, with the index showing more weakness. This downturn reflects the broader economic challenges that China is grappling with right now. You see, the stock market often mirrors how investors feel about the economy, and right now, there's a lot of concern swirling around. The ongoing economic slowdown, along with deflationary pressures, is putting a strain on things. We've talked about falling producer prices, manufacturing shrinking, and consumers tightening their belts. All these factors are playing into the mix. But wait, there's more. Geopolitical tensions and regulatory uncertainty are throwing more fuel on the fire. The government's crackdown on certain industries like tech and education has investors feeling jittery about what's next. And let's not forget about the Chinese yuan taking a dip. A weaker currency can make investors a bit skittish, worrying about money flowing out of the country and what that means for the economy's health. So in a nutshell, the stock market's mood reflects a bunch of challenges China is facing: deflation, slowing growth, regulatory unknowns, and currency wobbles. These issues aren't going away overnight, so investors will be keeping a close eye on how things unfold in the coming months. One of China's big real estate players just went under. Huh? That's got me thinking about the state of China's economy. Seems like they're facing some hurdles lately. Growth has hit the brakes, and they've shifted focus from a market-led approach to relying more on state-owned businesses. Plus, there's a bit too much reliance on real estate, which is causing some trouble, especially in commercial spaces. Now, you might wonder, how does this affect those here in the US? Well, our economic ties with China are important, mainly because we buy a lot of stuff they make, but our financial systems and production lines aren't too tangled up with theirs. So unless China's issues cause some major ripples in their economy or financial scene, we might feel some effects, but they shouldn't rock our boat too hard. Alright, let's talk about youth unemployment for a moment. Now, this is a bit of a messy situation. China's unemployment numbers got so bad that they stopped reporting them altogether. But here's the backstory. Back in 1998, China decided to ramp up higher education. They built schools, hired professionals, and handed out scholarships like candy. The idea was to create a smarter workforce and compete globally. Sounds good, right? Well, not exactly. See, they pumped out more college grads and there were jobs for them. We've got a whopping 21% of young adults without work. That's a big jump since 2018. Some people are even resorting to buying lottery tickets in hopes of a financial miracle. It's gotten so tough that many young Chinese are staying home instead of job hunting. And get this, China says it's just a misunderstanding and stopped reporting the numbers to improve the surveys. Yeah, right. But hey, we'll let you be the judge of that. Now on to the next one, the real estate crisis. It's been a wild ride over the past decade. Chinese people love investing in property, seeing it as a safe bet. Prices were shooting up like crazy, and even though the government was trying to slow things down, they were building houses like there was no tomorrow, with some cities using lotteries to dish them out. 70% of the country's wealth is tied up in real estate. That's huge. People were going all out to buy homes, even if it meant borrowing way more than they could afford, and then, bam, the property market took a huge dip. Suddenly, developers were struggling to get cash, projects were left half done, and protests were breaking out everywhere. Evergrande, one of the big players, went bust, leaving billions of dollars in debt. And now, another giant, Country Garden, is on shaky ground too. Their debts? A staggering $230 billion. China's tried to save the day by slashing interest rates, but it might be too little, too late. Over 50 developers are currently drowning in debt, dragging the economy down with them. It's a mess and it's causing deflation, prices going down instead of up. Finally, there's the deflation problem. Instead of prices going up, they're heading south. When prices drop, it usually means people aren't buying as much. And when your money's worth more if you hang on to it, you're less likely to splash out. That means businesses sell even less, which leads to more price drops. It's a vicious cycle. And while it might not send us hurtling into an economic abyss, it's a big deal. In China, folks are holding on to their cash tight, especially after years of lockdown. Companies are feeling the pinch too, cutting jobs left and right. Plus, with housing prices in a slump, people are watching their savings vanish. It's a mess, and it's hitting China's economy hard. And then there's this shadow banking crisis. It's like traditional banks but without all the rules. One of China's biggest players is in hot water after missing payments to some big companies. If they don't pay up, it could set off a chain reaction, tanking the whole economy. Sure, it's not confirmed yet, but it's got people worried. Luckily, the US seems pretty shielded from all this chaos. Our exposure to China's financial mess is tiny compared to our economy. So while it's a bumpy ride over in China, we're staying pretty steady. But hey, keep an eye on those stocks. You might get some good deals. Until then, if you want to know more about what's going on with the US economy, make sure to click on this next video about Biden's insane plan.